Market Perspectives in the U.S. Elections. I'm Mo Geisinger from Educational Events at Fidelity, and I will be your moderator today. Our conversation today is with Goldman Sachs, and they will provide their views on the upcoming U.S. elections and how they believe the markets could be impacted. Let's welcome John Tousley, Managing Director and Global Head of Market Strategy at Goldman Sachs. Hello, John. Great to have you here.
Good morning. Great to be with you, Mo. Thanks for having me.
Thanks for being here. Before John starts his presentation, I have to go through some housekeeping items. We have a Q&A tool to the right of the video. If you are joining us on a laptop or desktop computer, you can submit questions and we will do our best to answer as many as time allows. You may also use the tool to add a comment or two and let us know what you thought about the webinar. On the bottom of your screen, there are buttons to download today's presentation as well as to access closed captioning. In the Q&A announcement tool, there is also a YouTube link if you're having any technical issues. After the presentation, John will be answering live audience questions. Make sure you want to come back for that. Some upcoming webinars: Singles and Money, Owning Your Financial Future. Today at 2 p.m. Tomorrow at 12, Insights Live, What's the Latest on the Markets? And also tomorrow, In the Money at 2 p.m. You can register for all these upcoming events and many more at www.fidelity.com/webinar. So with all this out of the way, I will hand it over to John, but I will pop back in to have that Q&A from our audience. See you in a bit. Thank you, John.
Thank you, Mo. Pleasure to be with everybody and look forward to having a robust conversation. Certainly the topics are very timely. So again, thank you for joining, and I will move into the presentation. Now there's about 20 pages. We'll probably cover 15 of them over the next 35, 40 minutes. And I want to talk a little bit about the market backdrop and some common topical questions we're getting about how do you invest in markets with a top-heavy concentrated leadership, the Mag 7, as we're all familiar. How do we think about duration and interest rates in today's environment? And then we're going to wrap that all around with how do you invest during the election cycle? What do you and don't you pay attention to? And what are the things that are going to be most important in this particular election? And hopefully we'll leave a little more informed and thoughtful about how we think about investing during election cycles. So let me just start with the base layer. This is an interesting time, by the way. We are, as of yesterday, the S&P 500 has hit 27 all-time highs this year, on pace for 28 today. There's only been 112 trading days, which means 1 out of every 4 days has been a new record high. This has been the best start year to date for an election year. And history tells us when you have a very good first half, you have an even better second half. So history is on our side with the start we've had to this year. But this is going to be a particularly interesting year. We go into the election. We have 2 candidates who have very, very deep, dedicated bases, but are also widely unpopular. We have 2 candidates who are matching up for the first time since 1950. We have a rematch. And since the first time since the 1890s, we have 2 candidates who are seeking both their second term in the Oval Office. So some historically unique periods, some unique candidates, and some unique global and US conditions to think about. Well, let's start with just how we're thinking about some of these things. And the easiest thing to do is look at the top graphic on the right. And these are our basic set of macroeconomic views. Our first view, kind of our highest conviction view, is GDP. We think this economy is going to grow in the mid-2s this year. We are not in the recession camp. We understand why there are some that are in the recession camp. And it makes me think a little bit about The Mona Lisa. If you've been to the Louvre in France, this is the hallmark featured piece of art. And people often approach the Mona Lisa and are underwhelmed by its size. And they ask, well, why is this such an historically significant piece of art? It's 700 years old. It was painted by Da Vinci. What makes this art so amazing? And many have said it is the enigmatic nature of her expression. It's ambiguous. She could be smiling. She could be frowning. She could be mad. She could be angry. She could be coy. She could be mysterious. You can see what you want in the Mona Lisa. Scientists have even looked at this and they've said, why do some people see a frown? And what they've determined is it's a little bit to do with your focus. If you look exclusively at the Mona Lisa's mouth, you have a high likelihood of just seeing a frown. But the more you pull back, the more you see facial expressions in the broader portrait, your probability of seeing a smile increases significantly, almost north of 90%. I bring up that analogy because I think it's a lot like the economy. You can absolutely focus on a handful of items, the inverted yield curve, the low level of consumer confidence, the low level of leading economic indicators. You can find things to focus on that would be consistent with economic downturns and recessions. But we think the more you pull back and look comprehensively at the economy, the more you will see an economic smile. And in fact, this is our highest conviction view, that we will see growth, the blue bar, in the mid twos this year. And our recession model would say only about 15% chance of a recession over the next 12 months. Let me put that 15% in perspective. Our unconditional model is 12%, meaning that at any given time, there is always at least a 12% chance of a recession over the next 12 months. We're never zero. So at 15%, we're just ever so slightly above the unconditional level of 12%. So we are in the ongoing late cycle expansion for the US economy. We expect inflation, as manifest by even today's number, to start to move again in the right direction. It's been moving in the right direction, but the rate of improvement really slowed down in the first quarter. We expect core PCE, which is the Fed's preferred measure of inflation, to end this year at 2.8 from 3.2 the prior year. Now, we thought originally this year it would be as low as 2.3. So we've adjusted the number a couple times to reflect the stickiness of shelter and housing and some pockets of inflation. But we do believe that we will start to see these ongoing improvements in inflation pick up during the second half of this year. Today's report on CPI, 3.3% year over year on headline, 3.4% on core, both numbers marginally better than expected. So we may be reestablishing this trend of improving inflation. That's important because when we get to the third set of bars, it's our view on the Fed. What do we think the Fed's going to do? We absolutely believe the Fed is done raising interest rates and that the bar to restart raising interest rates is very, very high. What we have adjusted multiple times throughout the year along with the market is that because the rate of improvement in inflation has slowed down, the rate that the Federal Reserve is going to lower interest rates has also slowed down. At 5.4%, short-term interest rates are restrictive. Long-term, they could be a bit of a problem for the economy. So we know the Fed ultimately, their next direction is to start to lower interest rates to a more neutral level. But because inflation is sticky, because the economy is proven to be really resilient, the labor market's in decent shape, the Fed isn't in a hurry. So we expect the Fed to start cutting interest rates in September by 25 basis points and also in November. So 2 cuts this year. That is a little ahead of market pricing, but not too far off. Again, I would say, you know, where our highest conviction view is that growth, we're going to remain positive and resilient growth. Our lowest conviction view is, yes, we believe the Fed's going to cut, but when exactly they do it, we think that's still, you know, the devil is still in the details. We expect interest rates to move slightly lower, the 10-year Treasury from, you know, highs of about 4.7% this year, now is at about 4.3. So we think we're kind of in that neighborhood of where interest rates are going to be. The big takeaway for interest rates is even though the Federal Reserve will probably be lowering interest rates on the front end of the curve, our large deficit suggests that interest rates are probably going to be higher because it's going to be costly to fund the deficit. I often say when asked when is the deficit a problem, and I'm like, the deficit's not a problem until it is. And we've moved into that issue where the market is increasingly concerned that we are growing this deficit during a period of time right now where we should actually be shrinking the deficit. We're post pandemic. We're on the recovery track. We have full employment. We should actually be shrinking the deficit right now, and we're not making progress. The market is concerned about that. And then in terms of the S&P 500, we expect the S&P 500 to be up 9% this year. We are up 13 already. So where do you go when you arrive? I will go through a page and show you the different directions we think the market can take from here. But we believe that the market reflects a lot of very good news, that it should. But we think the market is probably fairly priced at or near current levels, maybe slightly even below. All right, there's a lot of directions this market can go. And I think, we put a little graphic down here basically saying, here would be our 10-year expected returns. So we give 4 scenarios on the bottom here versus the average since 1950 all the way on the right. And what you can see is in basically every scenario, we expect stocks to return a little bit less over the next 10 years than they have in recent past. Now, they could do relatively well under a Goldilocks scenario, which is kind of like the scenario we're in right now. Good growth, non-recessionary resilience in the economy, healthy labor markets, good cash balances, and absence of a recession. They might even be able to do a little bit better if we get that AI, artificial intelligence kicker that we're expecting that could improve GDP through major gains in productivity. And then we have some other scenarios that if growth really slows down, we have full valuation, or if we cannot, under a stagflation scenario, get control of inflation, we could have some scenarios where we start to see equities lag historical averages. Fixed income, in our view, is going to be in line with historical averages. We think fixed income looks particularly attractive right now. And for the first time in many years, a good diversified balanced portfolio to us seems to be the right solution. Whatever the long-term plan is, that may have felt like that wasn't working in 2021, 2022, or 2023 because the market was very narrow in what was performing. We think a good diversified portfolio today looks really quite attractive. Now, let me go into a couple areas, things that we always talk about, things that are on our radar, things we worry a little bit about that we think can be sources of volatility. The first box here is basically everything I've said. All the good news is baked into the market already. It's there. But we haven't had really any volatility. In fact, it has been over 300 days since we've had a 2% drawdown in the market. 2%. We normally have a 2% drawdown about every 29 trading days, so a little more than every a month. We haven't had that, so the markets have not been volatile. But there is a certain amount of pessimism that's out there that we're going to talk a little bit about. But the first thing we worry about is the market is really, truly priced for perfection. A lot of very good news is in here. That's also reflected in valuations. And when we look at the Mag 7, the dominant performing companies, the largest companies in the S&P 500, they are not incredibly high valuation given their profitability and earnings, but they certainly are not cheap at 33 times earnings. And then with inflation, most of the inflation improvement we made was last year. And as we talked about earlier, we really have slowed down. And so if we do not start to reaccelerate with inflation towards 2%, that's going to delay what the Fed can do. And that could be a problem for the market. And then clearly, this is a geopolitically complex world. We have at least 4 countries that are actively working, collaborating against Western interests, sharing arms, sharing intelligence. This creates, red lines and lines in the sand, and all kinds of opportunities for military and political mistakes. And that could introduce additional counterparties into regional conflicts. And these are things that we think are logical risks that are out there. I think the thing that's probably the most challenging, and this is going to impact how we think about the elections as well, is just the impact on sentiment and inflation. The reality is if we look at trend inflation going back to 2019, and we stated our 2%, prices since 2020 would be up about 9%. On average, prices are actually up 21%. So even though inflation is acting better, it is going to take years for this inflation trend to get back to the 2% trend. So every time we go out, fast casual, we buy something, we're reminded how much more prices are ahead of trend. And that impacts sentiment and confidence and political views. Inflation is really an issue that the market's trying to digest right now, and we are way off of trend, even though we're starting to improve. And I bring this up because it's gonna, in a couple slides, we're gonna revisit this topic. I wanna show you things we don't quite worry about. We think consumers are actually in pretty good shape. One of the ways we measure, it's a very simple construct, but we have the misery index. And on the misery index, it's two things: the unemployment rate, do I have a job? And the inflation rate, can I afford to pay for things? Do I have a job and can I pay for things? Almost 80% of the time, the misery index is worse than it is today. And so we are definitely in, at least historically, very reasonable financial places. Our household wealth is in the 98th percentile. Only 2 percentile time better, is it ever better than where we are today? Significant liquidity on balance sheets. Your personal investment accounts are probably near record highs. Your cash balances are probably near record highs. Like, the financial state of Americans is in good shape. There's more than $20 trillion of untapped home equity in the system. And so even though we have challenges with housing, it's not challenges of speculation, it's challenges of affordability. It's challenges of captive equity because people don't want to, they're kind of, married to their mortgage. But we've seen money market balances increase 46%, and the labor market has now moved to 28 months of being at or below 4%. It's really hard to have recessions when people have jobs. Now, some people will say, well, aren't the consumers over their ski tips? We're seeing record high consumer debt. Is that going to be a problem? Is that the canary in the coal mine? And we certainly watch it, but because we're an expanding economy always, and because there's always leverage in an expanding economy, the amount of consumer debt is almost always definitionally going to be hitting record levels. So the question is not the size of the debt, but the affordability. Can we manage it relative to our income? And the chart on the bottom left just shows revolving consumer credit as a percent of disposable income. And if you look at the trends here, you can see that we had a decade-long improvement in our consumer balance sheet. Then it massively improved during COVID as we had these cash injections and nowhere to spend the money. And then coming out of COVID, we see that we started to re-lever up. Prices were up. We decided to spend some money, catch up from spending that we didn't have for 18 months. And we can see that we have re-levered our balance sheet, but we are just barely, not even quite to pre-COVID levels. So our affordability and our manageability of our deficit, of our debt, is still quite good. And so, yes, you're going to see headlines, record consumer credit out there, true, but we are still, in terms of the manageability and the affordability of it, look really quite good. Now, here's an interesting nuance in the data. When you think about the economy, one of the challenges we have is the data saying a couple of different things. When we look at growth, we break down growth into what we call hard and soft data. So roughly, there are about 40 economic indicators that we put into this index we call the current activity indicator. And these 40 mixed together are a very, very accurate representation of what's happening in the economy. So it's honestly, it's better, it's smoother, and more timely than GDP. So when we do a first slice of this economic data, the data falls into two camps: hard data and soft data. Well, what's hard data? Hard data is concrete. It's easy to measure. It is the number of things. It's a measure of activity. It's indisputable. It's not opinion-based. It's the number of cars, the number of permits, the number of homes, the number of widgets. It's what's getting done in an economy. And the blue bars in this chart represent hard data. And so over the last 2 years, as we have worried about a recession, if you look at the contribution from the activity in the economy, the hard data, we have seen positive contributions the entire time. Like in many ways, this makes me recall back to Y2K. I worked at a regional bank, and we worried about what was going to happen at the stroke of midnight, the year 2000, because we had coding problems. And what we ended up having was a complete and total global non-event. So I think about the hard data that's similar to Y2K. We have worried about a recession for so long, and yet it's not in the activity, it's not in the data. That's the blue bars. Now, I'm going to say but. Well, the but is the soft data. The soft data are the economic indicators that are more sentiment and survey based. Consumer confidence. How do you feel about things? Do you think this is a good time to buy a car? Do you think you'll have better job security a year from now? So it's a more subjective assessment of what's happening in the economy. And so even though the hard data, the activity is firm and expanding, for some reason, we just don't feel good about the conditions. And so you can see a lot of negative prints on the soft data. Some of this is geopolitical. Most of this is inflation. So when we look at other periods, we have a handful of periods where my hard data is going up and my soft data is going down. Like, what are the things that drive this divergence in activity versus opinion? Number one thing is inflation. Inflation just has these long, sticky tentacles. And as I showed you two charts ago, it's going to take years for inflation to get back to trend. And it's probably going to take years for people to get comfortable with the current prices of things. And it's going to take years for people to realize it might be a 6.5 to 7.5 mortgage, 30-year fixed mortgage. That might be the cost of buying a home today. And so that impacts sentiment and keeps the soft data really low. There's a little bit of a political element to this. When they're the highest voting category is the economy, particularly for Republicans. And when Republicans are polled, if there's a Democrat in the White House, they don't like the economy. And so we have a kind of the current political composition hurts the polling in this data. And then the last reason why we get this mismatch between hard and soft data is it's really difficult to get a poll today, get a representative audience. Everybody's on a cell phone. Nobody takes unsolicited calls. Certainly they won't take it if they need 20 minutes to do an unsolicited survey. And so just like political polls, economic polls are really difficult to get representative audiences. And so we think that there's a bias that is a little more pessimistic than the underlying sentiment actually is that's reflected in the data. Here's the bottom line. If you're concerned about a recession, the soft data is there for you. That's your economic frown. There's concern and sentiment and pessimism across the economy that exists. We would suggest the more reliable data, if you want to see an economic smile, is in the hard data. It's more reliable, it's more consistent. We think it's a better representation of what's happening in the economy. It's one of the main reasons why we continue to expect late cycle economic expansion is the reliability of the hard activity-based data. So what does this all mean? It means, in our view, that the Fed, if you look at the chart on the left, will begin, as I already said, to lower interest rates. But at the end of the day, what I think is most important is we're going to have an economy. If you look at the top row, where the U.S. is going to grow mid-twos. I know our numbers are a little different page over page, but call it mid-twos. Euro is going to grow about 1%. Japan's going to have positive growth. The UK is going to be almost 1%. China about 5%. Again, we think this is ongoing economic expansion, not without its risks, but this is ongoing expansion. And what it means for capital market assets is, again, we think fair value for the S&P 500, 5,200. We see slightly better returns for the rest of the year outside the United States. We expect interest rates to edge slightly lower from current levels, consistent with today's CPI. We'll probably get a little bit of that trend. Not a lot of activity in currencies, and the main activity in currencies will be mostly driven by any divergence between one central bank's policy in one area versus another central bank, and that shift in short-term interest rates. And continue to think, particularly in the long run, that commodities are relatively attractive after decades of underinvestment And as we rebuild basically the planet for more efficient, green, climate-aware sources of production and energy, we don't have enough commodities to do that. So we see a really long super cycle for commodities long term. In the near term, they trade like financial assets. In the long run, they'll trade more like physical assets, and that's what we would be investing in. Okay, I had mentioned on the very first slide that there's a couple paths that the market can go. Goldilocks plus AI, stagflation, stagnation, and that's kind of the macro view. Well, where's the stock market potentially go? We think fair value 5,200. We're above that. Market doesn't care what Goldman Sachs thinks at all on these matters. We might think 5,200 is fair value, but there's clearly some ways that this market goes higher. There's some paths where this market could go lower as well. The path to 6,000. So we're roughly a little more than 5,400. How do we get to 6,000? Well, our first scenario is just more of the same. Ongoing mega cap exceptionalism. What's been happening in the last 2 years continues to happen. These economic disruptors and juggernauts, particularly that are proximate to AI infrastructure, the early stages of AI build out, they just continue to deliver on profits, on earnings, and these handful of companies drive the overall stock market higher. That's how you get to 6,000, just more of the same. We could see a different path where we head higher, but it's going to feel different. And this is the one that most investors are waiting for, where it's the unmagnificent 493 start to participate and outperform the Mag 7. This would be a broadening of the market performance. We've seen a little bit of that. We think it, could happen with slightly lower interest rates, but still high conviction of economic growth. And instead of the Mag 7 continuing to take off, that momentum translates into the rest of the S&P 500, and we get a broader rally taking the market to 5,800. Now, we do see a couple opposite scenarios, and I would say the risks are relatively balanced with the bias being higher, not lower. 4,500 in our view is could be the third scenario, which is a catch down, which is kind of the opposite of the first scenario. If we run into an environment where everything that was going well for the mega caps starts to unwind, they start to miss earnings, there's a major devaluation that would happen with a handful of mega tech names. They are over-owned, so they would be oversold into that market, and a handful of names could take the overall stock market to 4,500. There's that scenario, but it would require a major hiccup in terms of earnings momentum. Nothing that we've seen whatsoever with these big names. Or a different way to get to 4,500 could be the fourth scenario, which is, we don't really call it a recession, I would call it a growth scare. And this would probably be more of a global event where maybe the United States and Iran or another counterparty ended up getting more directly involved in some of these regional conflicts. Where the markets just went risk off, and they said, "Listen, I don't know what the end game is here, and so I'm going to go risk off. I'm going to wait and see." We do believe in both of these scenarios, the 4,500, that the Fed would accelerate their easing campaign if we were to start to see trouble in the capital markets, and that's what we call the Fed put. This idea that if things get too bad, the Fed will step in and stabilize the markets. So at 4,500, we do conceivably think that you'd start to get the Fed changing their narrative and maybe not just being exclusively focused on inflation, but also being focused on stabilizing capital markets. So a bunch of directions to go. I would say, given the breadth of directions, I'd just stick to the long-term plan. We think the bias is higher. If you've got a well-designed plan, I think you're in really good shape. I'm going to do an executive process here because I want to get to the political slides. Slide 10, the main takeaway here is that when it comes to higher interest rates, that means higher cost of capital. The chart on the right basically says that when I have higher cost of capital, the market becomes more idiosyncratic, meaning the returns are generated by company-specific events, not by the market itself. This means that everything is becoming bottom-up, organic. It's about the individual company, much less about the sector or the region. And that's why the markets tend to get a little more narrow, as the market is saying right now, I want reliably profitable companies with free cash flow that are disrupting. I want profits in big companies. And so just this is a market that becomes a little more bottom up and a little more driven by micro. Some people would say, well, if that's the case, why don't I just buy the big companies? Why don't I just own the top 10 and ride them? And the answer is because that's never really proven to be a good strategy. When you are in the top 10, you don't stay there. The chart on the left basically looks at companies going back to 1990 that were top 10 companies in the S&P 500 and what percentage of them stayed there. And if you look at the dashed line, you can see that about 40% of companies that are in the top 10 are not there 5 years later. Why? Because when you're in the top 10, you're profitable, you invite competition. People are going to want to come into your space. It's number one. And number two, when you're profitable and you're large, you invite regulation. And you can see that every day in the news that the regulators are coming after the big companies saying, we think you have an unfair advantage. And so we watch that. And so what happens is over time, it's really tough to stay on top. And the chart on the right basically shows that the performance of the top 10 companies over time tends to move lower and lower. And the underperformance relative to the rest of the market tends to actually grow. Now, I know that doesn't even seem conceivable right now with the power and the dominance and the profitability and the cash moats that some of these companies have. I'm not saying the top 10 are about to massively underperform. I'm just saying history is not on their side. And the idea of just owning these 10 names and calling it good, we don't think the math will support that view. You want to be more diversified. You want to own these great companies, but you also want to be trying to figure out who are the next top 10 because we know they're going to rotate in and out. In fixed income, the one question we get all the time is when do I start to lower my cash balances? And the answer, again, history says is now. Not because there's better yields with longer maturity bonds, but there can be better performance. The chart on the left shows you 2 lines 6 times. These are the 6 cycles for the Fed where they paused, which is the top line. And then the line right below it would be the cut. So we see these periods where I have 6 pauses and 6 cuts. The percentage numbers there represent how much did the longer bond outperform the shorter bond over that period between the pause and the cut. Not even after we know they're going to outperform after the cut, but during the pause. And the answer is on average by about 9%. So if you're thinking exclusively about cash flow, you might say, you know what, I'm going to be patient with my cash. And that's fine. But if you're thinking about total return, history says that owning a little bit of duration and some longer maturities, even before the cuts start, is the right strategy. And so if you're over allocated liquidity, this is an idea you should be thinking about is when do I start pushing out my maturities? And history says now. And then if you look, another way to look at it is if I look on my aggregate bond index, my munis, my investment grade, my high yield, this is the range of yields. That's the shaded area. The line is my median and the dot is where we are today. And across all fixed income, we were above median on income opportunities. So on a 20-year basis and 10-year basis looks relatively attractive. All right. Now, I got to ask for everyone's patience. We're going to go through the elections a little bit. Again, this is way more than just 2 candidates. These are candidates that are incredibly different. This is a climate where constituents are incredibly different. It's rare, but we have an environment now where the Democratic Party's top 5 priorities, excuse me, and the Republican top 5 priorities don't overlap. So we are literally, there's no common, issue between the parties that really, everyone's like, well, I think this candidate's going to be slightly better on this. Like at the end of the day, these are candidates fighting slightly different agendas. And so this is cultural as well, what's happening in the United States and frankly across the world. But when we do look at some of the things that are most important, the economy, not surprisingly, polls to be one of the top concerns. Immigration, a top concern. The state and preservation of democracy, a top concern. So these are the top 3. If we look at current polling as to who's perceived to do better in these areas, not surprisingly, I think Trump leads with the economy, leads with immigration. does not lead with democracy. Now, we can debate these all day long, and I know that as I go through this, I'm going to say things in a way that will infuriate half of you. The reality is this is just to get a sampling as to where people are and where the priorities are. Even when we poll on democracy, some would say, well, democracy is the politicization of the Justice Department. And others would say, no, we'll never have an election again if Donald Trump is elected. So like people look at these terms differently. So take this all really with a grain of salt, and what it's really saying. What we know more than anything is the election is going to be really, really close. The House is basically a toss-up. The Senate, probably about an 80% chance, flips to Republican control just because the calendar is so favorable for the Senate. For the Republicans, there are 34 seats up for re-election. 24 are held by Democrats. The Joe Manchin seat is likely, all but likely, to move to a Republican. It's a convincingly Republican area. So that puts it at a 50-50 Senate. And then you have states like Montana and Ohio that are very competitive for the Democrats, and so seen as very vulnerable, and Nevada would also fall into that camp. So there's the market thinks that there's a real high likelihood that Republicans can take the Senate by maybe as little as 1, but maybe as many as 3, possibly 4 seats. And then you get to the White House, and we all know that the White House is a race to 270 electoral votes. As you look at the map on the left, the gray states are the states that are largely decided. And then these red states are the toss-ups. This is where the election will be won and lost. The table on the right shows that these swing states, as we will call them, in 2016, all but one of them, Nevada, went for Donald Trump in 2016. And in 2020, all of them but North Carolina went for Joe Biden. If we look at the current polling, and by the way, we are still almost 5+ months out from the election. That's a lifetime in an election, particularly with these two candidates. If you look at the current polling at the state level, so while nationally Biden and Trump are kind of head to head, at these 7 swing states, President Trump enjoys consistent polling advantage. It's really close in Michigan and Wisconsin. There's a sense that Kennedy is polling a little bit more from Trump in Michigan. I don't think any of these states they're all too close to call at this point, but these are the states where you're going to see the election really decided. If we gave Michigan, Wisconsin, or Michigan and Pennsylvania, and Nevada, which generally go Democrat, then that would put on Tuesday night, November 5th, the Democrats at 266 votes on the starting line. I don't know if we can't really do that, but if we gave them the states that they won by 1% in the last election, that would put them at 266. All they would have to do is win either Arizona, Georgia, or Wisconsin. They just have to win one. If we use that same logic with the Republicans, they need to win Arizona, Georgia, and Wisconsin. So again, too early to tell, but these are the states where it's really going to come down to it. Now, I want to talk about something really quickly, and then I'll hand it back to Mo here. What do you do about this? I've probably inflamed a few passions. You've thought about your vote. You've thought about the opposition. We often tend to treat elections in a very binary way, which is, well, if the opposition wins, I'm selling everything. I'm moving to Canada. We look at blue and white outcomes, or blue and red outcomes, as black and white, all or nothing. And we can't do that. We have to stop doing that, because the economy is going to endure these candidates. Your portfolio will be around longer than these candidates. And so legislation matters, to be sure, but the chart on the right, I wanted to show you kind of a quick little takeaway. which is, let's go back to 1953. Eisenhower's going to be inaugurated. And let's say you say, you know what? I've got $10,000. I'm going to only invest when there's a Republican in the White House. I know Republicans are better for the economy, so I'm just going to vote when they're in charge. Well, that $10,000 has become today about $83,000. If, on the other hand, you bleed blue, and like, you know what, I'm so tired of hearing Republicans say how good they are for the economy. I think Democrats do it better. And I'm only going to invest when there's a Democrat in the White House. Well, in that scenario, your $10,000 has become about $240,000. Congratulations, Democrats. You actually have White House bragging rights going back to 1953. If, on the other hand, you said, you know what, I'm not going to politicize my portfolio whatsoever. I'm going to let time, earnings, and the US economy do all the heavy lifting for me. And rather than be in and out of the market, I'm just going to let it ride. That $10,000 has become $2 million. The reality is, we do an extensive amount of analytics on elections, and the only thing I can generally say with statistical certainty is every time I put a political layer or political decision embedded into a portfolio, there's less money in that portfolio over time. And so we would say that, going back a chart, that while I can give you any kind of data, I can show you Republicans are best for the markets, I can show you Democrats are, I can show you divided Congress, unified, I can show you any data you want to reflect your political beliefs. But what I cannot do is I cannot make that data statistically relevant. I can't make it statistically significant. I can't make it investable. I can't make it useful. It's coincidental. And it all changes with the timeframes I select. The reality is the predictability of what the market's going to do based on the presidential election is an R-square of 0.02. What the Senate looks like, 0. House, 0. The year of the president, 0. Again, does not mean legislation doesn't matter. It just means it's really difficult to invest in elections. So ultimately, our main takeaway would be politically active, be engaged, go canvass, but do not express your political view with a trade. You do it with a vote. That is the most important takeaway I can share with you about the data. So with that, Mo, I'm going to turn it over to you, welcome you back to the Zoom, and be more than happy to take any questions.
That was fantastic. Thank you so much. I have to comment about what you were saying about the Mona Lisa. And remember a couple of years ago, it was going throughout the internet, what color dress is this? Is it yellow or blue?
Yeah.
So that was very interesting. I love that. All right, so you're ready.
Let's do it.
Q&A. All right, so I know you mentioned stagnation and stagflation. And I know you have the definition of that in the glossary. I'm just wondering, can you just tackle that for everybody that's
Yeah, hold on here. We're going to go for a wild ride on the slides.
okay.
The question goes back to the very first slide. So stagnation would just be low growth. This would be sub 1% growth. We've got a couple little definitions here, more in the glossary you said. But think about stagnation as really shallow economic growth and kind of sticky inflation. Stagflation, that one shift in that one, a couple of letters there, simply means that we get inflation consistently north of, like, low growth, but consistently high inflation. And so it's something that we often harken back to the late 1970s and early 80s in England. And it was an environment where, like, the economic principle is, well, it's okay to have, or you normally have inflation when you're overheating, you're growing too fast. But what ends up happening is you can have stagflation, which is you have too much inflation, but you're not growing at all. That's like the worst of all the outcomes. And the challenge often there And we saw a little bit of stagflation coming out of COVID in the sense that maybe it was the supply chains that are disrupted. It's not there's too much demand in the system. We just can't supply the system. So there could be a number of reasons for it. But think about stagnation as just very low growth, a real sluggish economy, and stagflation as sluggish economy, but with too much inflation on top of it. And so what, not surprisingly, what you see is in stagnation, your bonds do relatively well. You're not growing that much, but you don't have too much inflation. When I move to stagflation, my bonds do the worst of all the scenarios because I have too much inflation in the system.
Excellent. Thank you for that. Even I understood that. All right, so through the course of your presentation, you didn't address AI in much detail.
Yeah.
How significant might this technology be for the US economy, and how should investors think gaining exposure?
Okay, so there's going to be a couple different investment waves. This is big. I want you to think about AI in the same conversation as when the US adopted electricity, how transformative it was for an economy to adopt electricity broadly. It took us 50 years to do that. We're going to do AI in 7 to 10. It's the equivalent of the internet and how that enhanced productivity for all of us. It's the equivalent of the PC computer moving into our home. And what, I'm doing my Zoom from my home, and how that has changed our lives. This is a game changer in terms of potential productivity. Now, it might have what we call a little bit of a J curve, which is a hit up front and then a reacceleration. There are going to be some jobs that are easy to automate with AI, and others that are just going to be really additive too. So we think probably 75% of jobs are going to be creatively and enhanced by AI, not replaced by AI. And so this fear of AI replacing us, that's an overblown concept. The one thing we know is AI is not super creative, and it sometimes doesn't have great judgment. But what it can do is really replace very repeatable, understandable, predictable human decisions. So this is big. And when we're asked where to invest, I often get the question slightly differently. What inning are we in? What inning of the ballgame? And we think we're at the national anthem. We haven't even started the game. This is the infrastructure investment side of it. And that's why you see the NVIDIAs, the Microsofts, the servers, the chips, the true fundamental structural building blocks of AI learning models. That's where it's going to happen. And then you're going to have, if you think about the best analogies, the gold rush. Who made the most money in the gold rush? It wasn't the miners. It was those who sold picks and shovels. It was those who supplied the miners. And we think we're going to have that same opportunity of AI picks and shovels, building out the infrastructure, moving down in market cap. And so I can't share names. I'm a macro strategist, but what I can tell you is we're still just in the build out of basic infrastructure, the direct linear part of AI. The picks and shovels will happen, and then we have a wave of what we call the beneficiaries. And they're not necessarily in the technology, but they're going to benefit from the technology. And here would be my bottom line. AI is every bit the reason why I would never bet against the United States. And I say that because the United States is going to be the epicenter of AI development. Our economy will probably see the productivity enhancements and benefits more, maybe a factor of 2 to 3 times better than other economies that are out there. And so yet again, technology is going to help our economy as we age and we have deficit issues and we have these things that are a drag on our economy. AI is going to come and backfill that better than it is for most other economies. And so it's one of the main reasons we remain incredibly constructive about the preeminence of the US equity market and the US economy.
Thank you. Phil asks, when the credit rating on treasuries go down and are the US markets defaulting on its debt, how will that impact the US equity market?
Well, if we actually defaulted on our debt, it would be devastating, but it sort of come down to what was the nature of the default. Was it a political default where we had the capacity to pay the bills, but we didn't have the willingness to pay the bills? And that was a political issue. The market might see through that. But if it ended up being an inability to pay our bills, that's a whole different story. Now, I think that is way, way off. So we are funded. Our deficits are funded largely at more than 50% through demand from the rest of the world. Our treasuries liquefy capital across the planet. They are the most desirable asset, the most liquid and most predictable asset on the planet. And so we enjoy an extreme benefit of being able to fund our deficits because the world prefers to fund our deficit over theirs. And they prefer the liquidity. The only way that I really worry, like we might get technical downgrades on our treasuries, and there's no doubt that servicing our deficit is becoming more and more problematic, and that will rob our investment in other parts of the economy. It'll lessen our ability to provide fiscal stimulus. It will lessen our ability to do additional programs. And so there's no doubt that the deficit's an issue, but we enjoy the Federal Reserve as a backstop. If we have a failed auction where we can't fund our deficit, the Federal Reserve could step in. That would cause market volatility, to be sure. But I don't think like this idea that we're in a position where we can't pay our bills is going to happen anytime soon. We have been spending more than we've been taking in for 50 years. Like our budget hasn't been balanced for a really long period of time, but we fund it again through the demand for our treasuries. So here's what I worry about. I don't worry about a half notch lower on a downgrade. I worry about a competitor. Is there an alternative to a dollar? Do we develop an alternative to a treasury? Because when you have that as an option for global investors, when China can say, you know what, I can actually fund something that has the same liquidity, predictability, and yield as a dollar in a treasury, that's when we have problems. But it's this absence of a competitor that I think keeps us in pretty good shape in the near to intermediate term and allows us to run these deficits that don't look great on paper, but functionally we're okay for a while. So I know that was a little bit of a meandering response. I'd say watch the deficit, watch the cost of the deficit, but there is no imminent problem of a default or a major downgrade that would disrupt the markets until there's really a true competitor out there that could replace the dollar.
What about, the question is, the tone of your economic views was quite constructive. What key developments could lead to change your view?
Watch the labor market. Jobs are super important in this economy. So watch the labor market. And if we start to see layoffs or any change in tone in corporate guidance on labor, that would be important. Watch retail sales. How does a consumer, are they feeling confident, or are they starting to retrench? So labor market, retail sales, super important. Two other items I'll give you. Inflation. The market is expecting inflation to move to 2% over the next 2 years. If it reverses course and we start consistently move higher, that is a game changer for the market. Completely will reprice the market. And then obviously geopolitical issues. I don't think geopolitical issues are any worse than really normal. We seem to always have some hot spots of geopolitical conflict, but the risk of escalation is quite high right now. And if we were to see, again, direct military engagements between the United States and Iran, we might have to shift our tone briefly for that. If we had any type of interaction with China, that's a true global game changer. So we'll watch geopolitical risk, we'll watch inflation, and we'll watch the U.S. labor market and consumer. Those are the big ones to keep your eye on.
Lots of moving parts.
Yeah, for sure.
So Brian asked, great chart on overall performance, but wouldn't certain sectors do better or worse based on the administration?
Yeah, so there's basically, the answer is yes. But there's 4 sectors that are typically the political sectors. Energy trades on elections because it has very different legislative outcomes between Republican and Democratic legislations. Healthcare will trade on elections. Tech will trade on elections, and the financial sector. Those are the big four that have significant political legislative risk depending on the outcome. Now, if we think about the administration, it's really not who's in the White House, but it's going to be the composition of Congress that's most important. And so, because we have to be able to legislate, we would say there's about a 35 to 40% chance there's a Republican sweep. But it would not be a veto proof or a filibuster proof majority. You wouldn't get 60 in the Senate. So anything that a Republican Party would do would have to come through reconciliation, which means it has to be fully paid for. And by the way, there are a couple of moderate Republicans that are not, like, you think Joe Manchin has driven the Democrats crazy. Susan Collins or Liz Murkowski don't vote party line at all. And so they would drive the Republicans crazy. So we are a long way from where a unified Republican government can jam certain legislation through that would be super supportive for financials, super supportive for energy. The most likely outcome is some form of divided government, which just really constrains any major legislative outcome. And so we think probably 60% probability Trump is elected, but we think the House slightly tilts to the Democrats. If the House is controlled by the Democrats, that handcuffs any major legislation. You can't even do reconciliation. And so I think if you get a big swing election, certain sectors are going to do better than others, clearly. But if you end up with the base case, which is some form of divided government, you're probably not going to see major swings in any particular sector. Last point I want to make on sector investing with politics. The market arbitrages its view within 2 to 3 days. So typically, if an election outcome is expected or a surprise outcome happens, it's in 2 to 3 days that those new prices are reflected in the sector. And so, like, the window of opportunity to make a sector shift based on the political outcome is really, really narrow and generally requires either a surprise outcome or a major swing outcome.
All right, I think we have time for one more question. Mr. Jim asks, is the Fed going to wait until after the election to cut rates? When the first rate cut occurs, will the market pull back?
So I think the history on this is kind of interesting. If you look at the election cycle and the Fed cycle, the Fed will, on average, move about 4 times during an election year. So those who believe that the Fed would not try and influence the election and would restrain from executing policy, there's no history supporting that. The reality is the Fed will actually probably even intentionally try and look very macro driven, and if they believe a policy move is required at a certain time, they've been clear that they'll act on it. If the Fed were to cut interest rates by 25 basis points, and so the market right now is priced somewhere between September and November. So if they move 25 basis points in September before the election, that would be a positive surprise, marginally a positive surprise to the market. You might get a little bit of a rally. But I don't think the Fed is in a position where they could move interest rates in a way that could be disruptive. There's only 25 or 50 basis points in either direction maximum that they could move before the election. That would be absorbed by the market fine. So I think there's a lot of hyperbole about what the Fed might do, and they'll hold off before an election. We don't have any evidence that that's actually the case. Makes for a better headline than it does for actual real data.
Well said. Thank you, John. What a fantastic hour. It was really a pleasure having you here with us. And thanks to all of you too. We know your time is valuable. Make sure you let us know your thoughts in the Q&A tool. And as a reminder, a number of great webinars are available to you at www.fidelity.com/webinar. We look forward to seeing you in future webinars. Until then, stay safe.